Cost plus pricing. Cost plus pricing involves adding a markup to the cost of producing or acquiring a product to establish the final price. The formula for cost plus pricing seems straightforward. Selling price equals cost plus markup. However, let's dig a little more into the components of cost and markup to see some of the challenges of this pricing policy. Cost refers to the total cost incurred in producing, manufacturing, or acquiring the product. It frequently includes variable costs, for example, materials, labor, and direct production expenses. Two other types of costs may be included in costs or may be factored into the margin. Fixed costs, for example, rent, salaries, and depreciation. Other expenses, such as overhead and administration costs. Like so many analyses, choosing which cost to use as a starting point can greatly influence the outcome of the analysis. Some options include marginal costs are the change in costs due to a change in production volumes. These are often the only relevant costs of a forward looking decision. All other costs are sunk and irrelevant. Standard costs or past average costs are often easily calculated from financial reports. They may be the outputs of an analysis from costing methods like activity based costing. As noted earlier, these costs may only include variable costs or may reflect full absorption costing, where overhead amounts have been allocated to products. Many companies can easily use inventory reports to find a cost per unit as a starting point for pricing. Other people may say a more relevant cost is the cost to replace inventory. This is reflected in a classic debate on how gasoline should be priced. Should the price of gas be based on what the station paid in the past for the gas in their tanks, or what it will cost them to replace the gas they are selling? The total costs of a product may go far beyond the costs of production. There may be customer service costs, product returns, and other costs that need to be added to direct production costs. Cost plus pricing also suffers from a chicken versus the egg problem. How can you set costs unless you know the volume you might sell? How can you estimate the volume without starting with an assumed price? In other words, which truly comes first as an assumption in cost plus pricing, the cost or the price? Costs per unit vary greatly based on the volumes you will produce. At certain volume thresholds, you will incur a step fixed cost, which will greatly increase costs above the pure variable costs. Step fixed costs are costs that don't change over a range of production, but then greatly change when a threshold is reached. The per unit allocation of fixed costs also varies greatly based on assumed volumes. If you have $1 million of fixed costs, the per unit allocation is $1,000 at 1,000 units of production, but only $100 at 10,000 units. That's a $900 difference in price using a cost plus pricing methodology. I'll return to this chicken versus the egg problem later in this lesson. The markup is the amount added to the cost to determine the selling price. Markup can be expressed as a fixed amount or a percentage of the cost. Like costs, there are options for determining the markup: the profit margin the business wants to achieve, a company's cost of capital. As noted earlier, if costs are defined as only variable costs, then a company might include fixed costs and overhead in the markup in addition to a profit amount. There are rules of thumb in some industries for markup amounts. When I worked in restaurants, pricing was often set at 3 times the costs. I had a client in another industry that billed custom work at 2 times their cost. These and other common markup options can reasonably answer the question: what is the correct overall amount of markups for my company? The question they don't often answer well is: what is the correct markup for each product? For example, grocery stores are notorious for having loss leader products like milk and eggs that attract people to the store, in the hopes that those shoppers will then buy other products with high margins. The margins of the loss leaders and the other products will be radically different. I noted that restaurant prices were set around 3 times food costs at restaurants. At a restaurant I worked at, soda and our little loaves of bread were priced at 10 times their costs. Margins on alcohol were high. margins on main dishes were low. This is why servers are coached to upsell customers on drinks, appetizers, side dishes, and desserts. Those are the high margin products. Cost plus pricing has been historically very popular for the following reasons. Cost plus pricing is straightforward and easy to understand. Both employees and customers can quickly grasp how prices are determined, which can lead to more transparent and predictable pricing. This can make it appear more objective and defensible to company employees, especially sales staff, who must negotiate pricing with customers. Administering pricing policies with this methodology may also be easier. Cost plus pricing also requires much less information and effort gathering information than other methodologies. The costs often come from costing information a company already has. Adding a markup to the costs is a simple calculation compared to other pricing methodologies. This pricing method ensures that a business covers its production costs, including both variable and fixed expenses. The margin provides a safety net for the company to avoid selling products at a loss. Businesses can easily control and adjust their profit margins by setting the markup percentage. This allows them to achieve their desired profit levels consistently. Some consider it a guaranteed profit, which may not be true. I'll explain this further in the disadvantages section later. Cost plus pricing provides a stable pricing structure, making it suitable for industries with high production costs or where market conditions are volatile. It helps companies avoid dramatic price fluctuations. This is especially true when competitors also use a cost plus methodology or have stable pricing. Often, stability is based on the assumption that all competitors have similar cost structures. However, it does not guarantee that all competitors require the same margin on their costs in cost plus pricing. Cost plus pricing can be beneficial when the cost of goods or services fluctuates due to factors like inflation, changes in supply chain costs, or unforeseen disruptions. Companies can adjust their markup to adapt to these changes and maintain profitability. Customers consider pricing to be fair when companies base their pricing on costs plus a reasonable margin. Employees also see this as fair to both customers and the company. Cost plus pricing is often required or preferred in government contracting and regulated industries. This ensures that costs are transparent, auditable, and fair for all parties involved. Some of the grants and contracts I had when I was the CFO of a community health center were based on cost recovery. Despite its popularity, most pricing experts take a very dim view of cost plus pricing. Here are some of the significant drawbacks they see with it. The biggest drawback of cost plus pricing is that it doesn't take into account what customers are willing to pay based on their perception of the product's value. It's completely blind to the market and customers. This can result in underpricing if the perceived value is higher than the cost plus price, or overpricing if it's lower, potentially leading to missed revenue opportunities. In a good market, you leave money on the table. Your revenue is capped by your costs and your margin. The purpose of pricing is to maximize marginal contribution, which cost plus pricing ignores. In a bad market, you overprice and lose sales volume and revenue. The loss of volume causes your per unit cost to increase. Your fixed costs are spread over fewer units. If you are beholden to a cost plus pricing strategy, you will then raise prices to cover the higher unit costs. This puts you further out of the market in a pricing death spiral. Relying solely on cost plus pricing can make a business less competitive in markets where competitors use different pricing strategies, such as value based pricing or dynamic pricing. This can lead to a loss of market share. It may not incentivize cost control and operational efficiency within the organization, since the pricing is primarily cost driven. Costs are assumed to be able to be passed on to customers. This can lead to higher costs and reduced profitability over time. Determining the appropriate markup percentage can be challenging. If the markup is too low, it might not provide a sufficient profit margin, while a markup that's too high can deter price sensitive customers. Companies may struggle to determine what a fair return margin is for each product or component of a product. This can get political very quickly when different products under different managers are told to set their pricing based on different margins. Fairness is assessed by employees not only by fairness to customers, but also by fairness between departments. Even picking costs, which would seem much easier to determine, can be difficult. I've built profitability systems and then spent hours justifying output costs from it. The assumptions in the system came from the people now challenging the results. I noted earlier that companies need to decide whether to use marginal costs, standard costs without overhead allocations, or fully loaded costs. Company energy is focused on setting internal costs and margins. These discussions can be contentious and suck company energy. That time and effort may be better spent exploring opportunities, opportunity costs, and how the customer values the product. Past costs that are irrelevant to forward looking economic decisions are called sunk costs. The sunk cost fallacy or sunk cost bias is incorrectly using these costs when making decisions. Cost plus pricing is extremely prone to this. The clearest example is when past fixed costs are included in the cost or margin used for cost plus pricing. Company staff who point to cost plus pricing to claim we have to make a profit or we can't sell below cost may cause the company to pick a price that does not maximize the revenue and profit the company can make going forward. Anyone who has had to liquidate excess inventory at a steep discount knows that you have to accept whatever price you can get. I noted earlier that the costs in cost plus pricing are often set by historical accounting rather than replacement costs or incremental costs. Matching past costs to future sales follows GAAP, generally accepted accounting principles, but isn't effective for financial decision making. Accounting and finance staff can be especially prone to GAAP induced blindness. This furthers the image of them being out of touch with customers, markets, and maybe even reality. Businesses that use cost plus pricing may underestimate their costs, especially if they fail to account for all relevant expenses, including indirect and overhead costs. Reliance on cost data assumes that cost calculations are accurate and up to date. Inaccurate cost data can lead to incorrect pricing decisions. This can lead to lower profits or losses. Cost plus pricing can be inflexible when market conditions change. It may not allow a company to quickly adjust prices in response to changes in demand, supply, or competitive pressures. In businesses that offer a wide range of products or services with varying costs and demand, managing and applying a consistent cost plus pricing strategy can be complex. If all products are assigned the same margin, you can't easily differentiate products for pricing strategies. For example, you can't pair loss leaders and high margin products to create profitable bundles of customer purchases. Also, different customers have different costs to serve them, so you must segment your customers, products, or channels and determine the cost and margin for each. You may think that cost plus pricing concepts are irredeemable after that litany of dysfunction. All is not lost. First, there may be times when cost plus pricing may be useful. It might work for products with a high percentage of variable costs and companies with low overhead. Some small businesses fit that description. Cost plus pricing may be a good starting point for new products that have no competitors and little customer awareness of the product. It may be very difficult to assess a customer's willingness to pay. You may start with cost plus pricing and then adjust from that price over time. You may look inward at costs and capacity constraints to change pricing. For example, you may charge higher prices during periods of higher capacity utilization and lower prices during lower utilization. This is common in many industries. Others can utilize this method to avoid step costs while still capturing some business during times of excess capacity. Once again, I caution in some of the examples I just listed that the relevant costs for setting cost plus pricing are marginal costs, not fully loaded historical costs. How do we tackle the chicken versus the egg issue I brought up earlier? Cost plus pricing implicitly assumes a volume to determine costs. It also assumes that the market will buy that volume at whatever price is calculated. This is sheer fantasy. Where can we start? I have a dear friend named Cost Volume Profit or CVP analysis. The formula for CVP is gross revenue minus total variable costs minus fixed costs equals profit. This can be further broken down into number of units sold times price minus number of units sold times cost minus fixed costs equals profit. Cost plus pricing and CVP share many of the same components. Every formula needs some assumptions to be set to calculate a result. Cost plus pricing assumes a volume. For example, number of units, variable costs, fixed cost, and profit to determine a price. Cost plus pricing treats fixed costs as variable costs to determine a price as an output. Sales volume is treated as a fixed assumption and price as an outcome. Let's step back and determine which of the assumptions are most certain and most in your control. My guess is that they are your costs. Let's say your owners demand a certain profit margin, as most owners do. That leaves price and volume as the most uncertain variables. These are the ones we need to model. My friend's CVP is usually shown as a straight line guy like this. I'll show this in more detail later. However, CVP has a sibling named two variable data table that allows us to model two assumptions at once. That complex animal looks like this image. This data table finds the maximum variable cost to achieve a given minimum margin and cover a given fixed cost for various prices and volumes. The first column is a set of prices, the top row is a set of volumes, and the numbers in the rest of the table are per unit costs. Other assumptions are listed to the left of the table. Each intersection of a price and volume in the table is the maximum per unit cost to achieve the margin target on the left of the table, which is cell B4. The question for company leaders is, can we produce the product at the variable cost or less at all likely intersections of prices and volumes? For example, can we produce each unit for less than $275 if we expect to sell 100 units at $500? If so, we'll achieve the margin we want and cover fixed costs. If we only sold 400 units at $500, our variable costs would need to be $200 or less to achieve our desired margin and profit. The table cells with negative numbers mean that costs would have to be negative to achieve the margin. This is impossible in reality, of course. All this means that we can start by setting up a data table that models two uncertain assumptions of price and volume. If we assume a profit assumption and the fixed costs, or ignore them as sunk, we can back into what variable costs need to be. So, it's best to start with an array of volumes and prices to determine if we can produce the product at a cost low enough to achieve our target profit at varying volumes. It flips standard cost plus pricing backward, but it reflects what's really most uncertain in pricing.